Greetings. It is time for another monthly update on inflation and whether quantitative easing in fact causes inflation or not, because as anyone who is watching the news can see, the media is in complete hysteria about inflation while not being willing to attribute whatever inflation upticks we're seeing to the true cause, which is a deliberate reduction in domestic oil and natural gas production, and not Federal Reserve quantitative easing, which has been ramping down for quite some time and also was going on for 11 years, as I often describe in my other videos around quantitative easing. But for today, we're going to talk about just inflation. And long-term viewers know that I set a very straightforward metric of when inflation is at an optimal point and above which it will be considered high. And I'm going to add a third parameter to that. And that third parameter is the 10-year US Treasury yield, whether that is 3% or not. Now, why am I adding this parameter? Because this is a reflection of future expectations of inflation, where the CPI is the past and the Goldman Sachs Commodity Index is also the past. And I'm keeping this at 3% simply to be uniform with these other two metrics. However, 3% is a very, very, very low bar. The Fed funds rate can be 0% and the 10-year yield can be 3%, and that's still a 3% yield curve spread. So this is a very low bar. It would be actually more appropriate for me to make this 4%, but I like the symmetry of 3, 3, and 3. And therefore, I consider inflation to be problematic only when all three of these numbers are above 3%. Again, this is not making the criteria more stringent because this is a very, very low bar. For most of the last 70 years, the 10-year US Treasury yield has been a lot higher than 3%. But in this atom age of technological deflation, I believe that is permanently no longer going to be the case outside of very brief episodes, if that. So, what have each of these numbers gotten to in the most recent month? That is the subject of this video. So for that, we go to the first one, the US CPI. So as always, we go to the BLS website and we go to Consumer Price Index over here. And then we go to formatting options to see more choices. So we choose original data value and 12-month percentage change. So this is the original value of the CPI. And remember, this steep upward curve is only offsetting the negative portion from here. And you have to look at this in a geometric sense. So what is the 10-year average CPI? That doesn't move that easily because we want to smooth out short-term spikes and troughs. Right now, the media is trying to make everyone hysterical about inflation, but when inflation was in reverse, in deflation, during the start of COVID-19, and also during 2014 or so, then these inflation mongers were nowhere to be found, when in fact, deflation is more worrisome for the average person than inflation, as I explain in this video up here in the upper right-hand corner. So we take this scientific calculator and take the 10-year average inflation rate by taking months that were exactly 10 years apart at the beginning and end of the 10-month series. So we take this number 284 and divide it by this number 229. So 284 divided by 229, 1.24. So 24% inflation over 10 years. How much is that per year? We take the 1/10th root of this number to determine how much is the average inflation per year over this 10-year period. I hope everyone understands the arithmetic of how that is done. X raised to y, 0.1 is the 1/10th root. You get this number, and then you minus 1 and multiply by 100 to get the percentage. 2.2%. That is the average CPI inflation rate over the last 10 years. It's a little higher than the prior month and the month before that, but it's only edging up by about 0.1% per month and is nowhere near the 3% threshold that I set in my inflation criteria table that you just saw. So 2.2% is the average CPI inflation rate in the United States over the last 10 years. Now, the United States is only one country, and saying that Federal Reserve printing is causing inflation is not only wrong from an atom point of view regarding technological deflation, it's also wrong because that is a US-only metric, not a worldwide metric. Both Europe and Japan are doing much more quantitative easing than the United States did in proportion to the size of their economies, and nobody claims those places have high inflation. Inflation is only high right now because the United States deliberately clamped down on oil and natural gas production domestically, which nobody who wants the well-being of the US economy would ever possibly do. because that was the best thing to happen to the US economy in the last 10 years. As we go down to these annualized inflation rates, yes, it's very high right now, but this gradient is already saturating substantially, and that's why the average was the 2.2% that we saw. I've said for several months that by April, May 2022, which is next month after, this is going to start coming down on a year-over-year basis. The recent oil spike might have delayed that a little bit, but any oil spike attracts more technological forces to bring it down into deflation, and also the geopolitical events that happened because of the rise in oil price that might not have happened otherwise. So we'll see, but this 10-year average is the one that matters. And now to get a worldwide metric, and since we're talking about oil, we go to the second parameter in my table, which is the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index. And the 10-year inflation rate of this is 0.47%. Now, for a long time, it was in negative. Recently, things have spiked up, mainly because of oil. And the oil spike, once again, is because the current administration has clamped down on domestic oil production and natural gas production in the U.S. This has caused the worldwide price of oil to rise, and a lot of oil-producing dictatorships become emboldened when that happens, and then they do things that make the price of oil rise higher still. But then this gets reversed very quickly, and we will see this fall just as swiftly as it rose, mark my words. But the 10-year compound annual growth rate of this is nowhere near 3%. I actually want this to get up to 3% so that there is more technological disruption of commodity prices and the supply of oil, natural gas, gold, copper, and everything else increases a lot, causing another decade of deflation. The atom, the accelerating technomic medium of the world, is attracted to things that are unusually expensive, and when commodity prices rise due to some aberration that attracts a greater percentage of the atom leaves the other disruptions it was working on and gets to work on crushing this particular price increase. And we've seen this happen time and time again, and I have many videos on this channel about that. So commodity prices, which is the purest metric of inflation because it's worldwide, it is not distortable by just US central bank money printing, contrary to what all these inflation mongers on television say. Remember, the United States has only done 25% of the entire world's money printing, so to attribute US money printing to worldwide commodity price increases is absurd. And oil prices only rose because of the reasons I mentioned, a deliberate reduction in US oil and natural gas production. Quantitative easing has been going on for 12 years, greater than the duration of this entire chart, and there was deflation along the whole while. So then this takes us to the third parameter that I track, which is a new parameter that we are discussing for the first time in this monthly series, and that is the 10-year US Treasury Yield. The Treasury Yield is only 2%, 2.00 exactly, in fact. It's nowhere near 3%, and it was above 3% and even well into double digits during the 1970s and early 80s for a while. And even during the 90s and 2000s, it was well above 3%. But now I believe it is permanently below 3%, barring certain aberrant things that the Federal Reserve does, such as temporarily try and unwind its balance sheet by selling treasuries back, which always gets reversed because the stock market corrects and forces them to buy treasuries again. So it is only at 2.00%. At its lowest point, it was under 1%. It has now risen to 2% because quantitative easing has ended. But each rise becomes exponentially harder because then the economy contracts and the Federal Reserve has to print money again. So this is the 50+ year chart, and to show how 3% is now hard to reach, even though it was above 3% all the time until recently, is just a tremendous validation of the atom thesis and how technological deflation is pervading into more and more things. Bonds as an asset class are becoming unviable under the reality of exponential technological deflation. I wish the governments of the world were able to see that. And remember, the US Treasury rate is still plus 2%. There are, in fact, $17 trillion of sovereign bonds worldwide that have a negative interest rate, so below zero. Negative interest rate. I described that in this video up here. If you want to see a shorter term, I go to the 5-year chart. You see it could only get above 3% for a short while in the summer of 2019 because the Federal Reserve was tightening rapidly. And that type of artificial tightening got immediately undone because of the COVID-19 crisis, but they would have had to print more anyway because the stock market would have corrected. And now it's languishing at 2%. You simply cannot go back to the assumption that we're going to have high inflation and yields are going to return to 7%, which is what all those PhD economists have memorized as being normal, simply because that's what the yield was when many of them were in school studying for their PhDs. Just because that was when they were around, that's what everything has to be, and therefore their policy thought is so tainted and so intellectually empty that it's really quite a shame. But this 10-year Treasury yield is an important metric. Even though it's a US only metric, I could be more stringent and require all sovereign bonds of all the major economies to be above 3%, but that's even harder to get. I just want the US Treasury yield to be above 3% before we say that inflation is starting to get high. And that has to happen in conjunction with the other two metrics, the CPI and the Goldman Sachs Commodity Index, 10-year compounded annual growth rates also being above 3%. So now we go back over there. So here we are. US CPI should be above 3%, and Goldman Sachs Commodity Index should be above 3%, 10-year compound annual growth rate in both cases, and the 10-year forward metric, the US Treasury yield, should also be above 3%. And unless all three of these thresholds are breached at the same time, I don't care if one is above 3% and the other two are not, all three have to be above 3% at the same time. That is still a very, very low bar, because for most of the time before the age of quantitative easing and technological deflation getting into critical mass, all three were above 3%. If you go back to the 1970s, all three were in double digits even for a certain period of time. So what does this month register at based on what we have just seen? CPI is 2.2%, as we saw in this video. Goldman Sachs Commodity Index is at 0.47%, still a long ways from 3%, but this is pretty volatile. This can go above 3% and below 3% in a short time. The other two can't move that quickly. And the US Treasury yield is at 2%. So still a full percentage point before it gets to 3%. Inflation is nowhere near any structural worrisome threshold at all. Don't watch the daily news, because it will make you crazy and lead you into bad investment decisions. This current inflation spike will vanish just as quickly as it arose, even though there are multiple artificial factors working towards worsening inflation, such as a deliberate reduction in US natural gas and oil production, without which not only would we not have even had the small blip that we're seeing now, but you also would not have had Russia invading Ukraine at all, because they would not have the confidence to do that, because Russia is an oil-centric economy and is heavily dependent on selling its oil to other countries and earning revenue from that. But none of these metrics are near 3% at all, and that is the takeaway from this video. Stay the course. We are entering the atom age, the age of exponential technological deflation, and absolutely nothing that's going on is contradicting the thesis at all. And I've been consistent about this throughout, 3%, 3%, and now I'm adding this 10-year Treasury yield simply because I'm confident enough that this very low bar, much lower than it was for most of the entire half century before the last few years, is also something that will not be breached very often anymore, because like I said, $17 trillion of bonds outside the US have negative yield. The US at least still has positive yield. But anyway, this was the monthly inflation update for February 2022 data, at least regarding the CPI. The Goldman Sachs Commodity Index and the 10-year US Treasury yield are all priced daily, so this is absolutely current up to today, March 11, 2022. I hope you found this video to be educational and informative. If you like this type of content, I encourage you to upvote this video, hit the notification button, and subscribe to this channel. Thank you very much for watching.